I feel that because of the supply and demand gap that we have right now in 2027 and 2028, the value of those assets will be a lot higher. And overall, in 30 years, if I get the returns that these particular indexes have given in the last 30 years, I will end up with almost $6 million in the next 30 years. Now, I know that a lot of people will say that no, the Indian rupee will actually appreciate against US dollar and Canadian dollar, but I do not have any historic evidence of that. And therefore, I wanted to double down on technology, and I felt that this is a good way of doing it. Now, I was able to beat the Canadian Stock Exchange, which was a little bit sluggish in the last 1 year. I'll be investing in the Indian stock market as well, and that would make about 20% of the portfolio. I'll talk about how to buy pre-construction, what projects to buy, what numbers look like, how to analyze the pre-construction project. So I've done a thorough research on the project that I invested in. This is one video that I've been meaning to make for a long time, and it's one of the most asked videos on the channel. Today, I'll be dissecting my investment strategy for 2024 and 2025 when it comes to stocks, ETFs, as well as real estate. If you are a big fan of numbers, facts, and reasoning, this video is perfect for you. So let's get started. So in today's presentation, first of all, we'll be talking about my stocks and ETF strategy, which is spread across Canada, US, and India. And I'll talk about, even though I'm diversifying my portfolio into 3 markets, I'll also be simplifying it by investing into fewer number of ETFs and stocks. The second thing that we talk about is when you're investing in India, should we invest in India directly or should we invest into ETFs that are listed on the US and Canadian Stock Exchange? I'll talk about what I'm doing and why. And finally, we'll be talking about the real estate strategy that I'm adopting for 2024 given the environment right now. Let's talk about stock and ETF portfolio. Now, my investment strategy has changed in the last 4 years. I've been investing in the stock market for the last 4 years. So when we came to Canada in 2020, the investment strategy was a little bit different. Canada was a very new market. My understanding of the North American landscape was limited and I was still learning. So 75% of all the investing money was going into the Canadian Stock Exchange at that time, and only 25% was going into US. But as I came to understand that the US market is much bigger, all the tech stocks and the tech companies are actually based out of the US. So therefore, US is probably a more growing economy than Canada. I changed my strategy from 75-25 in favor of Canada to a split of 50-50 in the US and Canada. Now, what I was also doing in the last 4 years was that I was actually doing 75 to 80% of my investments into exchange traded funds, which are also called ETFs. Now, these are basically aggregates of company. So instead of investing into individual stocks like Apple, Microsoft, Meta, you can actually invest into an aggregate of stocks, and that's what is called an ETF. So I was investing about 75 to 80% of my money into these ETFs, and I'll talk about the ETF that I invest in the subsequent slide. But about 20 to 25% of the remainder of my investing money was going into individual stocks as well. Now in 2024, I have changed my distribution a little bit. Instead of only investing in US and Canada, what I've done is I've increased the distribution towards US a little bit more, and I'll talk about why I made this change in the next slide. I've reduced the amount of money that I'm investing in Canada to about 20%, and I always wanted to introduce India in my mix, and therefore now I'll be investing in the Indian stock market as well, and that would make about 20% of the portfolio. I personally believe that this particular strategy of investing in 3 markets and a little bit more in US is much more balanced than what I used to have earlier. Besides being from India, I always wanted to invest in the market because I really believe in the long-term growth of the country. Now, if you want to know what my portfolio is and how I am investing and how I've invested so far, it's very, very transparent with Blossom now. So you can just download the app. It's free to download. I'm just doing a very shameless plug because I love this app, a lot. It's free to download, and you can actually analyze your stock portfolio. And not only that, you can actually analyze other people's stock portfolio. For instance, there's Canadian T-shirt, which is Adrian Barr. That's one of my inspirations when I got into the stock market. I can actually view his portfolio and what he's investing is. There's BD Investing, there's Joey. So many of these people who are investing very actively in the stock market are all there, and their portfolios are available on Blossom for everyone to see. So you can look at your all-time returns, where you're investing. You can actually break down into what are the growth stocks, So this is basically my portfolio, and you can just go and download Blossom and look at anyone's portfolio, or you can analyze your own as well. Then it also talks about the sectors that you are invested in versus other people on Blossom. So you are actually able to compare yourself to the market. You can also look at your yearly performance, 5-year performance, as well as breakup of dividend deal that you are getting. So it's a really amazing platform to analyze your portfolio and compare it with others. The link to join Blossom is in the description below. Now, talk about this transition that I'm making in my portfolio where I'm investing a lot more in the US and also introducing India in the mix. And there are some reasons why I'm making this transition. Number one is, yes, my performance for the last 1 year has been decent, which is about 8%. Now, I was able to beat the Canadian Stock Exchange, which was a little bit sluggish in the last 1 year. So I have been able to beat it by almost 80%. However, my portfolio falls short by a huge margin if I compare it with the growth in S&P 500. And one of the reasons why this is happening is because my portfolio is now currently skewed towards the Canadian stock market. Moreover, a lot of this 26% growth in the S&P 500 has come from the tech stocks like Meta, Nvidia, Microsoft, and my exposure to these stocks was really, really low. Now, one of the other reasons why I want to skew my portfolio towards US is because if you look at the top 10 companies in Canada, a lot of them are banks, and the only tech company that you see here is Shopify. Some of it is energy, some of it is, natural resources, some of it is railways. So the exposure to the tech sector is less than 2% if you are investing in Canada. Whereas if you compare this with the top 10 companies in US, off the bat, we can see that a lot of the tech companies are making the top 10 here. Not just that, the 10th largest company is in fact 5 times bigger than the largest company in Canada. In fact, there are 60 companies in the US which are bigger than the top company in Canada, which is RBC. And therefore, skewing my portfolio towards the Canadian stock market was hurting me, which is exactly why I'm making this transition. Now, let's talk about the investment strategy and which ETFs I'm investing in. So I have decided to invest $2,500 per month. Now, if you're starting new, I would highly recommend that you at least invest $100 a month, up to 20% of your net income. For me, $2,500 is less than 20% of my net income, but I'm someone who also wants to invest in real estate because I'm from the industry, and therefore I've restricted my investing budget to $2,500 per month. I'm doing that in 3 markets, which is US, Canada, and India, and I'm doing that in only 4 ETFs just to simplify my portfolio. The first ETF that I'm investing in is $1,000, which is 40% of all my investing money, which is $1,000 again, into S&P 500, and the ETF that I've chosen is VFV, which is listed on the Toronto Stock Exchange. These are the top 500 companies in the US. You're essentially investing in the US economy. In the last 1 year, it has actually grown by almost 30%, and therefore you see the 8% growth in my overall portfolio. It's actually skewed by my investment into VFV, which is almost 25% of my portfolio right now. Now, if I'm investing in VFV, what I'm investing is in technology. 30% of this index is made of technology, then 17% is made of consumer goods, which is basically FMCG, PepsiCo, all these big companies that we have that actually make the consumer goods. And then we have healthcare, and then we have financial services, which are essentially banks. And these are the top 10 companies that make almost 30% of VFV. That includes Microsoft, of course, that will be there. Then Apple, Nvidia, these are the top 3 companies anyways. We have Amazon, we have Meta, we have Google, we have Berkshire Hathaway, Tesla, Broadcom. Again, you will see a lot of tech companies here because that's what US is driven by. Now, VFE is only 40%, and the other 20% that I invest in US is actually going to the NASDAQ 100 index, which is essentially 100 largest non-financial companies in the US. I'll be investing $500 every single month in this particular portfolio, and the ETF that I've chosen is XQQ, which is also listed on the Toronto Stock Exchange. Now, this particular index has obviously performed a lot better because a lot of this is made by the tech companies, and the tech companies have done really well in the last 1 year. If you look at the sector distribution, over 50% is technology, 20% is consumer goods, and 16% is communications. And no surprise here, again, the top 10 companies that make this holding is a lot of tech companies. Now, of course, there is overlap between the first and the second one that I'm investing, because a lot of companies that are in this 100 index are also there in VFV, which is the top 500 companies. But the reason why I'm doing that is because I think in the next 20 to 30 years, we'll see a lot of technological advancement, and therefore I wanted to double down on technology, and I felt that this is a good way of doing it. The third ETF that I'm investing in is FTSE Canadian High Dividend, which is basically the top companies in Canada paying the highest dividend. The ticker name is VDY, and in the last 1 year, this has been very sluggish, but the good thing is that it actually pays a really healthy dividend of 5% that we'll talk about in the subsequent slides. But this is really heavy on financial services, energy, communication, utilities. We saw the top 10 companies in Canada. They are heavily skewed towards financial services and energy, and you see that 95% of this entire thing is actually these 4 sectors. If you look at the top 10 companies, again, you will see a lot of banks, you will see a lot of utility companies, and you will not see any of the tech companies, because Shopify, even though it's the top 3 companies in Canada, it does not pay any dividend, and therefore Shopify is actually not included in this particular calculation. And the fourth and the final ETF that I'm investing in is Nifty 50, which is the top 50 companies in India. And the ticker that I've used is ZID, which is also listed on the Toronto Stock Exchange. Now, the Indian stock market has also done really well, and the top 50 companies have grown by over 25% in the last 1 year. And the Indian sector is mostly made of technology, which is basically Infosys, Wipro, and TCS. And then you have consumer goods company, then you have energy company, financial services, basic materials. So all this makes the Indian market. We all know that. And if you look at the top 10 holdings, it's basically Reliance, Infosys, TCS, Axis Bank, Bharti Airtel, Unilever. So all the big companies, of course, are a part of this Nifty 50. Now, a big question that you might have is, why not invest in the Indian stock market directly? And I personally have 2 reasons for that. The first one is I do not plan to retire in India, and I'll have to get all that money with the capital gains out of India when I'm retiring. So if you're retiring in India, absolutely invest directly into the Indian stock market. You will probably be better off doing that. But if you're like me, you have to consider the risk of exchange rate here. What I mean by that is, if you're investing in the Indian stock market and the Indian rupee depreciates in 30 years, then the amount of money that you get from India to Canada will be a lot lower than what it should be. Now, I know that a lot of people will say that no, the Indian rupee will actually appreciate against US dollar and Canadian dollar, but I do not have any historic evidence of that. In the last 5 years, Indian rupee has depreciated by almost 15% to Canadian dollar. And in the last 30 years, it has depreciated by almost 63%. So yes, there's a chance that the Indian rupee will appreciate against Canadian dollar. But right now, we do not have any historic evidence of that. Now, let's assume that Indian rupee actually appreciates against dollar. The problem with that is that Infosys and TCS, all these tech services company will suffer because $1 million of contract that is outsourced from US right now to India is worth 6 crore rupees. But if Indian currency appreciates to double, the same $1 million contract will be worth a lot less. That would lead to unemployment in these companies. And because these companies are a big part of Indian economy, the economy will in fact start to suffer from the currency appreciation. Now, I may be completely wrong in my assessment and understanding here. And if you have a counterpoint, do share that in the comments below. So because I don't want to retire in India and I have to get that money that I invest in India out of India some point in future, I just feel that there are way more risks involved and I don't want to get into that hassle. Now let's quickly talk about the returns of these 4 ETFs. So VFV, which is S&P 500, 40% of my portfolio. The 1-year return has been really handsome, almost 30%. The 3-year return is slightly lower, 12.5%. 5-year is 14.4%. 10-year is 14.3%. And the 30-year return is 10%. So even if I feel that, it'll give me 10%, I think it's a decent return. It also has a dividend yield of 1.09%. Now, how dividend yield is calculated is that if you have a stock which is worth $100 and if you have 100 of those stocks, you will get $1.09 for every one stock that you own. The other important ratio that we need to look at is MER, which is management expense ratio. This basically is the cost of managing this fund. What 0.09% essentially means is if you invest in $10,000 in VFV, you'll be spending $9 in fees, which honestly is not a lot of money. If you talk about the other US investment that I'm making, which is XQQ, the 1-year return has been amazing because obviously the tech sector has done well. It's 50% plus. The 3-year return is about 11%, 5-year is 19%, 10-year is 16%, and 30-year return is still a healthy 13.8%. The dividend yield is lower because all these tech stocks don't really play a lot of dividend, and therefore it's 0.29%. So it's not a lot. And the MER for this is slightly higher at 0.39%. That basically means if you invest $10,000 in this particular stock, you would be paying almost $39 in fees. Now, as per experts, the MER ratio should be anywhere between 0.25% to 0.65%. Closer it is to 0.25%, the better it is. The third index that I invest is the Canadian index, which is VDY, which is about 20% of my money that I put into this. Then 0.1% growth in 1 year. So like we said, it didn't grow as much. But if you look at the long-term return, it's a lot better. It's about 8% in 30 years. 10 years is also 8%. The good thing about this one is that it has a low expense ratio of 0.22% and the dividend yield is almost 5%. What this means is this stock is listed at about $43. 5% means 5% of $43. So you get $2 for every share that you hold. So let's say you hold 100 shares of this, you get $200 every single year and you can reinvest those $200 into VDY. This is basically called dividend reinvestment plan or DRIP. That's the reason why, despite this being the lowest return from the mix, I still want to invest because I want to get the dividend income and reinvest that to get higher returns. Now, last but not the least, it's Nifty 50, which is India. 20% of my money goes towards that. 1-year return has been amazing because the Indian stock market has been going really well in the last 1 year, but long-term returns, if you look at, it's between 12 to 14%, 10-year, 30-year returns, and it also pays a dividend of 1.09%. The expense ratio is higher, about 0.67%. It's higher than what I would like to pay, but I could not find any other index which was lower than this, and it has decent allocation as well. This is a BMO index ZID. So yeah, there were a couple of them that I was looking at, but the expense ratio was almost 0.98% on that. So yeah, the expense ratio is high, but I think I at least can live with it. And if you have something which is better, do put it in the comments below. Now, what this translates into is if I invest $1,000 every single month, which I'm investing, in VFE, I invest $360,000 in the next 30 years, and the future value of this at a 10% increase. So what I've taken is the 30-year, year-on-year growth. That's what I'm taking. If this particular, VFE stock grows at 10% year-on-year for the next 30 years, my $360,000 investment or $1,000 per month investment will grow into 2.1 million. And I've done this for all other indexes. And overall, in 30 years, if I get the returns that these particular indexes have given in the last 30 years, I will end up with almost $6 million in the next 30 years. Now, if you notice the future value, I have this VDY where I've written a number which is 1 million plus here. Now, what I'm saying here is that yes, the $180,000 will grow at an 8% year-on-year return to $709,000, which is not a very fancy return. However, if I invest all the dividends that I get, and again, this particular stock is actually giving me 5% dividend right now. If I'm able to reinvest that dividend, I will actually end up with a future value of over $1 million. So when you're looking at this particular stock, you also need to look at the dividend reinvestment that we are doing, because you're actually getting a very handsome dividend every single year if you invest in VDY. Now, I know that the video has actually gone really long and it's almost night here as well, but I also wanted to talk about the vehicles and platforms. So vehicles, when I say vehicles, it means that will you invest in TFSA? Will you invest in FHSA? You have RRSP, RESP. So all these are registered accounts. You get tax advantages here. And then you have non-registered accounts, which is basically your personal account where you don't have any tax advantages. Now, for me, TFSA and non-registered accounts make sense. I'm self-employed, so I don't have very high income that I take as dividends or as salary from my corporation. And therefore, it doesn't make sense for me to put into RRSP. Now, some people will have a different view, but what I do basically is that I invest in TFSA. So I max out my TFSA for both me and my wife. Now, once I have maxed out my TFSAs, I will invest through my non-registered account, and because I'm self-employed, I will be investing through my corporation every single month. Now, I personally invest my money through Wealthsimple. I think it's an amazing platform. It's a time-tested platform. It's a very old platform. It has the right level of protection. If the platform is to go down, your money is completely safe. Plus, it allows for fractional buying. What I mean by that is if you want to buy $50 of VFV, which is priced at about $123, and if you don't have $123 to invest, you can actually buy 0.4 share of VFE. So it allows for fractional buying, which is really amazing. The second thing is that like any other platform, it also allows for me to auto invest my money. Because I'm investing in the same ETFs, same amount of money every single month, it just is on autopilot, and I'm doing that on a monthly basis. Earlier I used to do weekly, but now just I don't have the time to do it weekly, so I've just turned into a monthly cycle now. Whether weekly is better than monthly, arguably maybe weekly is better because you actually dollar cost average better. But 30 years, I don't think it will make a lot of difference. And for analysis, I use Blossom, where you can do portfolio analysis, not just your portfolio, but other people's portfolio as well. You can join the community. You can follow news, and there are some courses that you can take if you go for the premium version of Blossom. And in some of those courses, you can actually make cash. Now, full disclosure, I'm a Blossom ambassador, but this is by far the best app that I have on my phone right now. So if you want to download these apps, the links to both Wealthsimple and Blossom are in the description below. Now, finally, I just have one last slide where I talk about the real estate strategy that I have in 2024. The first one is I want to buy one good pre-construction condo project delivering in 2027 and 2028. Now, I'm not very hopeful of where the market is going in the next 1 year. It could go up, it could go down. The economic scenario is, it's really, fluctuating right now. But I do believe that in 2027 and 2028, the market will recover. If it goes down right now, we'll be out of a recession. And I feel that because of the supply and demand gap that we have right now in 2027 and 2028, the value of those assets will be a lot higher. Now, the second one is more for my learning, where I want to do a fixer-upper, a BRRRR, or an infill project in KWC or Calgary. Now, I actually made an entire video on how to do an infill project. We did that with Gurvinder. If you have not seen that video, I'll link that in the description. But I really want to do one of these projects because I think doing these projects just makes you learn so much about construction, just makes you learn, how to general contract, how to talk to plumbers. So I just feel that, this is something that has been missing. Now, of course, I've done that in the US, but I was not actively involved in doing that. And therefore, I feel that, I need to do something which is closer to home. And that would be one of the action items that I have for this year. And the third one is I want to buy another cash flow property in Ohio, USA. The previous property has done really well for us. And I feel that the money that we get back from refinancing that, because it's been 1 year and we are getting the money back that we invested in, I'll be buying another cash flow investment property in Ohio, USA. Now, of these 3 action items that I have for this year, I've actually completed one of those. I've already bought the pre-construction property that I wanted to buy. It's in Milton. I'll talk about that project in the subsequent videos, so do subscribe to the channel if you have not done that. I'll talk about how to buy pre-construction, what projects to buy, what numbers look like, how to analyze the pre-construction project. So I've done a thorough research on the project that I invested in. I'll talk about that in detail in subsequent videos. And the second action point that we have, the fixer-upper, I actually put an offer this week. The video on that will come next week. I don't know if we'll get the project or not, but I'm pretty excited, on what that holds for us. But anyways, we actually shot the entire thing, and the numbers look amazing on that property. If we get that, it'll be an amazing project. So do subscribe to the channel if you have not done that, because whatever I do in my investing life, I actually want to share it with you so that we all can grow together. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए bye bye.